Okay, let's go ahead and get started. And welcome to our webinar today. My name is Bill Exeter. I'm the Chief Executive Officer for Exeter 1031 Exchange Services and Exeter Trust Company. One of our goals is to bring you educational information and programs so that you can make a better informed investment decision as you're going through your processes. So today we are partnering with Robert Hall and Associates, and we have the lovely Nicole Green, who's going to be presenting on all sorts of tax topics that might affect real estate. So with that, I will turn it over to Nicole.
Hi, everybody. I hope you guys are doing well. We're going to talk about taxes and things that really can help. I'm going to show some examples today so that you guys can really see things in effect. Let's see here. So, as stated, my name is Nicole Green. I work at Robert Hall and Associates. Robert Hall and Associates is a tax firm, and we specialize in. I mean, we do everything. We're not like super niche down or by any means, but we specialize in real estate, and that's because all of us, everybody that like all the partners here, are all deeply invested into real estate and we greatly believe in it and we've seen it work for so many of our clients. Thus, we've become really kind of big into like being known for real estate. We've been around since like the 70s, like 73, I believe. And we promote different types of strategies for people because the thing about taxes and it's the beautiful thing about taxes is that there's not a flat tax and you guys can take control over your own taxes. It's just a matter of you deciding what you want to do. And so I'm going to show some options today so people can see that they can combine certain strategies. They could do one or the other. They have so much control in their taxes. I could talk about taxes all day long. It's not an issue for me. I love it, but I understand that sometimes it gets quite personal because when people are generally asking me about a topic, I'm like, yeah, great. How much are we talking about here? And, obviously that could be quite personal. And so we offer free discovery calls. They're completely free and they help us get deep down into it. You can ask questions. If you want to scan the QR code, you can to set up a free discovery call, or you can email me directly, nicole.green@roberthalltaxes.com. Firstly, I am licensed by the federal government, so we work in all over the United States, a little internationally as well. This is purely educational. Let me also say, if you guys have questions while I'm speaking, you can definitely put your questions in the Q&A box, and I will happily go ahead and answer the questions. And then, of course, at the end, I will open it up to questions. So if I didn't get a chance to answer your questions, there's definitely going to be time at the end, but I don't mind pausing if you guys have a question. Okay, so when we're talking about real estate, one of the big things that people like to talk about is real estate professional. And I want to explain what real estate professional is and how you can qualify for real estate professional. And then I want to show you guys some of the benefits of real estate professional. And so, first of all, what is real estate professional? Why do people opt into it? And so, when we're talking about like rentals or investment properties, that is generally considered passive income. And rentals on your tax return are going to show losses. That's generally what they are always going to do. And that is perfectly fine. That is one of the benefits of rentals. That's why we like rentals, is because they should cash flow in your pocket, but on your tax returns, it should show a loss, a passive loss. And so that means all that cash flow is basically tax free for you. And this loss is going to be usually because of depreciation. Not all rentals show losses. If you if you're next to a stadium or you're doing short-term rentals, or you've had the property for a very, very long time, and so it's been depreciated for quite a while, then maybe it's not going to go ahead and show loss. Anywho, Rentals are generally considered passive, and so passive losses don't go against any other type of income unless it is passive. Passive losses go against passive income. And so your W-2 job or your business that you own, those are not passive. That is active income. And so like me and my family, we have rentals, and the rentals show losses, but that cannot go against my W-2 income because I'm an accountant and that doesn't, I just carry these losses and I carry them forward forever until I get to use them. If I were able to claim real estate professional, that would change those passive losses to active. And so that is one of the real big benefits because then it reduces your taxable income. You would have these losses that you could use to go against your W-2 income. And that's the whole kind of giddy up about it. Please note that with everything, there are good and bad parts to it, right? It's not just perfect and everything. And so, real estate professional does attract extra attention, is what I like to call, meaning there's more IRS scrutiny because it's really easy for people to check real estate professional. It's just like a box. You just click, and then you're like, oh, okay, now it's deemed that you're a real estate professional. And there's quite a few people that do their taxes at, on TurboTax or like H&R Block or whatever, and they might not have all of the accurate information, or they're just like, oh, nobody's going to catch me and I'm going to claim real estate professional. They don't really know if they're actually qualified for a real estate professional. And so this has attracted a lot more attention because you get people using this status incorrectly. So let's talk about how do you actually qualify for real estate professional. There are three things that you need to meet. You don't meet one, two, or three. We meet all three of these things. So first, we need to make sure that the majority of your earned income comes from real estate. And that means that if you have another job, like me as an accountant, then because that is the majority of my money, earned income, I cannot claim real estate professional. However, if you are a property manager or you're managing all your rentals or you are a broker or an agent or whatever, and that's deemed inside real estate profession, architects, like all of these things, then you're absolutely free and able to claim real estate. Then the majority of your earned income would be coming from real estate. Then you also need to meet the material participation rules, and this is the easiest. This is something that people don't even need to worry about. The material participation rules is 750 hours per year, and that really boils down to about 10 to 15 hours per week. Keep in mind, attending today would count as an hour. Looking for other rentals, that counts. Managing your own rental, that counts. It's really, really easy to get the 750 hours. So this one, I always tell people, don't worry about this one. This one's the easiest to get. And then the third thing that you need to make sure you have is that the majority of your working time comes from real estate. I had a client and he did like some tech thing or whatever, and he had 3 rentals and he wanted to claim real estate professional, and I was like, you can't claim real estate professional because you have this tech job. And he was like, Nicole, I promise you, I am really only working like 10 hours a week doing my coding thing or whatever that he did. And I was like, great, I get it. So you do meet the 750 hours rules. He definitely met, the majority of his earned income or the majority of his working time coming from real estate. But the income was the issue because he had a really high W-2. And so that made it so that he could not qualify. Even though he met 2 of the rules, he didn't meet all 3. And so he wasn't able to qualify for real estate professional. And then also on another note, we need to make sure that when you're claiming real estate professional, that there is actually a benefit for you, because you don't want to claim it, have extra attention, and there's no benefit. Like, we need to have the risk versus reward situation work out. And so we definitely need to make sure that you can actually see the benefit and it makes really great sense. So here, let me give an example. this family here, they've got 2 rentals, they've got 1 W-2, they've got some interest, blah, 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 capital gains because they sold a property, and their rentals are at a loss, but their AGI is more than 150,000, and so they're not able to use any passive income to go against any passive losses to go against passive income. And so their total tax, because refunds or if you owe at the end of the year, that's not so much important. It is important, but we really need to focus on the total bill. And so the total tax on the federal side is about $24,000. Now, because they'd only had one person as a earning income with the W-2, we were able to have the other spouse be real estate professional. And so the spouse as a real estate professional made those passive losses count in the year. And so here they're able to take this $37,000 loss. Totally, remember, it's a couple of rentals here. They're able to take this $37,000 loss, and that $37,000 loss is saving them just on the federal side about $10,000. They're also saving on the state side, but I'm just giving an example of here on the federal side. And so you can really see they didn't do anything. All they did is we just used the spouse as real estate professional because the one spouse is working and the other spouse was just managing the rentals. Thus, we're able to qualify the other spouse as real estate professional, and they were able to save about $10,000, not doing anything different. And it's just a really good example of a strategy that people can use. Another great thing that people are able to do is with short-term rentals. Short-term rentals are a way to move from passive to active, because a short-term rental it requires more time. It requires more energy. It is no longer this passive thing that maybe you're addressing once every 3 months or once a month or something like that. No, it's short term. You could be there daily, you could be there weekly. It's definitely more involved. And so this is no longer it being on the passive side, it's now active. And so you're going to see it reported as business income. What is a short-term rental? A short-term rental is going to be anything that you're renting out for 3 months or shorter, and also you need to offer a daily service. People do not need to elect for this daily service, but you just need to offer it. Of course, it can definitely be at charge. I recommend it. One of the most common things that people do is like they offer daily cleaning if people so want, so you can just have the cleaning person come every day. Or they'll offer like transportation, some easy stuff. And that I would definitely recommend that you put that inside like your post or wherever you're promoting the rental. And so once you do that, you can now put the rental on the business side and put it on the Schedule C as opposed for it to being on the Schedule E. And so in this exact scenario, they had multiple rentals, and one of the rentals was short term. They were able to have a business loss, this business loss of $11,000 because, again, depreciation, blah, blah, blah. This business loss took their AGI under that 150, and once you're under that 150, you're able to use some of the passive losses. If you're under $100,000, you can use up to $25,000 of passive losses to go against other types of income. And so here they're just under the 150, and so they were able to use just a little bit of the passive losses, really, really helping their total income or their total tax. It's a really nice thing that they were able to do. Another great benefit is a cost seg. Cost seg is a really, really nice strategy that people can use. Now, especially now that bonus depreciation has come back at 100%, cost segs are they have been even before, but they're really, really powerful right now. So let me explain first the basics about bonus depreciation and depreciation as a whole, so we can kind of all be on the same wavelength here. So depreciation is where you're taking your item and that you've purchased and you're spreading that expense over a period of time. And so like for a car, for example, you buy a car for $100,000 and you spread that over 5 years. Depreciation, the time period that you spread something over, so the car we're spreading over 5 years, basically getting about $20,000 of a deduction every year for 5 years until we get the 100. Which will total up to 100. We don't get an additional 100. The time frame, that 5 years, is already predetermined. Your accountant doesn't determine it. The tax assessor doesn't determine it. It's already predetermined by GAAP, general accepted accounting principles, and so everybody's using that same time frame. Now, certain things that have different time frames, so like a car is 5 years, a rental property is going to be 27 and a half years, a commercial property is going to be 39 years. And so when certain time frames have bonus depreciation, and that means you can take all of that depreciation in the first year. So a car, for example, because it is 5 years, if it's over, blah, 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 there are additional requirements, but if they meet all of those requirements, then you wanted to use bonus depreciation on the car, you absolutely can. Instead of taking $20,000 of a deduction over 5 years, every year for 5 years, you can take that $100,000 in the first year. And that's the big thing about bonus depreciation. It needs to be in the first year. And so you can use a cost seg to go and itemize the things in the house, and so that you can now have certain things that are eligible for that bonus depreciation. Thus, you're basically accelerating that depreciation. You're going into the future and you're saying, hey, I want some of that depreciation, and you're going to pull it forward. And so then the first 1, 2, and 3 years that you have done the cost seg, you're able to have these really, really large deductions, which is totally fine and totally amazing and absolutely wonderful. And I really see it as a great benefit for people. Let me show the example of how a cost seg is used. And so in this particular situation, this person has 2 rentals. One rental has been going on for quite a while, and then one rental is brand new. And that's why we're seeing positive income here, because they've got one rental that's been going on for quite a while. And so that rental is showing a lot of positive income. And then we have one rental brand new. It does have some losses. It's going against the other bits of positive income. And so now they're showing a total of $33,000. So we said, hey, let's take that new rental that you have. Let's do a cost seg on that new rental. That new rental was able to accelerate depreciation via the cost seg, because instead of 27 and a half years of depreciation, of a time frame for depreciation, certain things like windows, the refrigerator, like appliances, the different parts of the building have different timelines, and so they're eligible for bonus depreciation. And so with the cost seg, instead of having $33,000 of loss, we're showing $33,000 of positive income. We're showing about $11,000 of loss. And that is taking their almost $21,000 of total tax and dropping it to $11,000. Again, about a $10,000 difference here, because they're doing this cost seg. This is absolutely amazing and wonderful, and they're going to see this significant deduction on the federal side, and depending what state they're in, on the state side as well. Some states conform, some states don't conform. California definitely conforms. It's one of the benefits of a cost seg. And so you get this great deduction, and it's like great, amazing, wonderful. Now, I do say it is wonderful and it is amazing, but you need to think about why you want this deduction, because you're not creating losses here. We didn't create deductions. We took a deduction that you already were going to have. It's a deduction in the future, and we just pulled it forward. And so the reason we're doing that is got to be advantageous for us. It needs to be an actual benefit. And so if you want to expand your portfolio, this is a fabulous thing to do, because you take that $10,000 on the federal side, and let's say maybe there's a $5,000 on the state side, and you're going to have that for year 1, year 2, and a little bit of year 3. And so really, we could be looking at $45,000 of tax savings. Take that $45,000 of tax savings, go get another property, rinse and repeat, do a cost seg on that property, have another 3 years of really, really low tax, and take that tax savings, put it into another property, rinse and repeat. And so this is wonderful for expanding your portfolio. However, it is not great if we're going to just take the tax savings, take that $15,000 and go to Tahiti or Bali on vacation. No, that's like putting your vacation on a credit card. And we don't want to do that, because what is going to happen in the future is, because we're using our future deductions and we're using them today, is that we will not have those deductions in the future, which is going to be a different problem, because we're going to have some tax. But that's okay, because we have now completely quadrupled our portfolio. And so the benefit is absolutely outweighing the con, and there's other strategies that we can then implement to help with that. But it's a really, really good thing if you understand why you're doing it and what is the benefit for you. Again, cost segs are good for like multifamily homes and also commercial buildings, and that's just how they're configured. And because the assessor's going in there and they're actually looking at all the different parts of the building. Oh, we have a question. Let's see. I think Antonio, you have a question. Maybe you could type it inside the Q&A box, Antonio, or in the chat. Oh, okay. I see it. Can I touch on the negative implications of doing a cost seg? So the negative implications is that you're using your future depreciation. That's what the negative part is you're using your future depreciation. And so I'm taking a deduction that I would have had in the future, and I'm using it now. And so I can have additional tax. I will have additional taxes. And so my taxes won't show my rental won't show, my rental won't show a loss in the future, because I've taken away one of the really big deductions. But again, totally fine, because there's other strategies that you can do. Another implication can also be that you're going to see a good amount of extra attention, because you have this really big loss that's happening on your tax return. And so you can have the government come around, ask questions, which again, if you're doing a cost seg, I definitely would make sure that you're getting it from a really qualified person. It's not me, like the accountant, that's going to do your cost seg. You need to go to a cost seg company and get a licensed person, because then they will certify their cost segregation setting. So you just end up having to send that to the government, and the government may have some questions with that. And then also you need to make sure that, one, again, your property needs to generally be new, or you need to be doing like new renovations on it, because bonus depreciation is all about put in service date. When do you first put it in? And so if you have had a property for a while, we're not going to be doing a cost seg. If you've been renting out the property for a while, you could have had it for a while, but you didn't rent it out. And so if you've been renting out that property for a while, then we're not going to be doing a cost segregation stuff, because there's no eligible bonus depreciation. You are accelerating your depreciation for the year it was put into service. And so, and you want to make sure you have enough usable depreciation. Generally, we're looking for about $500,000 of usable depreciation. This is why I generally say it should be about, for new properties. Yes, you can do it on renovated properties, but you want about $500,000 of usable depreciation before it really makes sense. I also would say that for anybody that is thinking about doing a cost seg, you definitely need to make sure that you get a free analysis. Anybody worth their weight in, what's the expression, worth their weight in salt or whatever it is, anybody up to snuff that does the cost segs will give you a free analysis. And what you do with that free analysis is then you go and speak with your accountant to see if there's enough depreciation and it makes sense, because there's a cost for the cost seg. Generally costs, they range in price, and it really depends on the type of building you're going to use. You're going to be doing the cost seg and how far the person needs to travel to for that building. There's a couple of different factors, but a cost seg generally runs people about a few $1,000s, sometimes way more. And so there's a price to the cost seg. Obviously, there's a price to like the filing of your return and things like that. So there's an expense to doing a cost seg. And so we need to make sure that that is not getting eaten up. Your tax savings is not getting eaten up with all of the expenses. We need to make sure that it's absolutely worth it and you're still able to do your end goal. Again, this is why we say about the $500,000, at least $500,000 of usable depreciation. Like $500,000 is really the minimum that we're talking about for usable depreciation. And so get a free analysis and then go speak with your accountant to see if it actually works for you and it makes sense for what you're doing. And then somebody's asking a question. I'm in the Bay Area. Do you have any recommended folks that you could provide for a free assessment to perform a cost seg? I'm unsure if I have 500,000 of usable depreciation. Absolutely. Send me an email, Nicole. What's my email? Nicole.green at roberthalltaxes.com, and we can definitely connect you. I have a really great company that does cost segs, and they can connect you with like just at least a free analysis about it, and then you can speak with your accountant to see if it like actually makes sense. Again, just want to reiterate, put in service date. We really want to make sure that it's a property. Oh, you can also combine properties too. So like, let's say you're buying homes in like Alabama or whatever, and you're buying, a $200,000 home in Alabama and a $300,000 home in Alabama, and then another $100,000 home in Alabama. You can combine all three of those for the one cost seg, and now you have enough usable depreciation because we're combining these three homes as long as they're all put in service at the same, not the same month, but the same year. And now you have enough usable depreciation for the year. So it's not just one home, because I have one client and we've been doing a couple of cost segs, and he really doesn't want to do any more. We're not really trying to get one more property. We're trying to get actually one really big property right now, but he needed to do some renovations, and we have quite a few properties he has. And so he did renovations on 3 different properties, and then he bought one small property, and we combined all of that for the cost seg. We had enough usable depreciation, so he still really has pretty low tax going forward, so that we're using all that tax savings so that he can get one really big commercial thing that he has that's supposed to be like the cherry on top of his portfolio. And then let's now talk about 1031. So once something is like fully depreciated, if we want to sell the property, you're going to be like looking at some issues. And people think about like exit strategies, and like, when somebody is like, oh, I want to sell, my question is always, why do you want to sell? What is the purpose of us selling? Why are we getting out of the rental stuff? And usually their answer is going to be from a collection of different reasons. Either like they don't want to manage it anymore, they want to change states. There's going to be a collection of different reasons. And this is when 1031s really come into effect, because it might not be just, I don't want to be in the real estate world at all. It's usually something else about the real estate world. And so that just might mean, I'm saying might like 18 million times. Take a shot every time I say might. But that just might mean that the property you have is not the right property for you at this moment in time. And so a 1031 is really where it comes into effect here, because 1031 delays your tax. A 1031 is the amazing thing that says like, oh, okay, we're not going to pay that capital gains. Why don't you just put a little pin in that capital gains? We'll talk about that in the future, not now, delay. And what do we always say? Delay, delay, dot. And so if we do a cost seg on a property, we own a property, we do a cost seg on this property, now it's like fully depreciated. If we want to get out of the property, if we want to sell this property, we're going to have to pay all this capital gains because we've really depreciated the property. And we don't want that. We're just trying to move and we need the property to be in a new state. So we can do a 1031. And that's where you sell the said property and then you put the proceeds into a new property. And then you continue to use that property for rental use. And this is great. This is a way people can go from like single family to multifamily. You can go from something small to something big, because let's imagine you have your one rental, you've saved up, you have, let's say, single family rental, right? And then you saved up some money so that you can purchase another one, but you need to sell this other one so that you can get into a larger place, because this is single family. Now you want to buy a quadplex or, sixplex or something like that. And so we don't want to pay gain here on the single family. No, you do a 1031 and then you put all of that into the new property, and then you keep going, which is absolutely amazing. It's also a really good thing when people inherit stuff, because their basis is still very, very high. And so like maybe one person wants to sell and the other person that, like it's in a trust or whatever, and the other person doesn't. And so you can take your share and you can do a 1031 into a new property, which is absolutely amazing. As I said in my example, sometimes people want to get out of a property just because they want to change states. So you can do a 1031 into a different state. That's totally fine. You can have your rental in California. You can sell that rental or do the 1031 and get into a rental in Texas or Florida or whatever state that you absolutely want to be in. That really, really works. Another big reason that people are selling is because they need some money. They need some of that cash, and maybe they don't want to do a second or a HELOC or whatever. They just actually want to take some of their money out, or they want to downsize the property so that they can take some of that money out. And that is what we call boot. And this is, again, there's so many different types of 1031s, and there's so many advantages to 1031s. It's just literally an amazing thing. But this is what we call boot. Boot is where you're actually not putting all the proceeds inside the 1031. You're actually taking some of that money out of it. And so I want to show an example. And so let's say here this person is selling their home. They're going to be showing $500,000 of gain, like a lot of gain. They have $100,000 of tax because they have all of this gain. This is just on the federal side. They're getting rocked on the state side too. And so this is a really bad thing. And it's like, well, wait, why are you selling? Oh, you're selling because you need some more liquid cash because your mother is going to move in with you, and you want to just have some more liquid cash for medical expenses. Okay, let's do a 1031. Let's take out $100,000 of boot so that you can use it, and then you're fully able to have it. Or let's say, sorry, the example is actually $150,000 of boot. And so in this example, they're taking $150,000 of boot. They still had some basis, so we're only showing $100,000 of gain. And instead of that $100,000 of federal tax, we're now to $15,000 of federal tax. Like, this is absolutely amazing. And they still have the $150,000 that they're able to do whatever they wanted to do with. And they also still have a property that's generating income. And so you don't have to like kind of do all or nothing here. You can do small things, and you can also do things to get out of it in a strategic manner, because when we do have rentals and you do things, you need to be conscious that it's not always just going to be a quick I'm out type of thing, especially if you have a large portfolio. There's definitely going to be things that you need to think about in terms of getting out, in terms of changing your mind, or in terms of even growing. And so that's kind of the big thing. Now, 1031s are absolutely amazing. The only time I think 1031s are a problem is when people are like, let me DIY this, let me do this myself. No, 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 no. But you need to be with an accommodator, because there are so many little things that are going to kind of trip you up. One of the big things that people always kind of mess up is the timeline. 1031s have really, really strict timelines, and there's very few instances where you can see these timelines being extended. And so you need to follow the timelines. Really, really, really important. And so one of the big things, 45 days. You need to, from whenever you relinquish your property, you have 45 days to identify up to 3 replacement properties. I always recommend one of your replacement properties should be a DST, Delaware Statutory Trust. And that is just going to be like a big, massive $300 million real estate, whatever, and you're like a 0.5% owner in this, and it becomes really, really passive. You have no say, because again, you're a 0.5% owner, but it allows it so that if one of the other 2 properties falls through, that you don't have your 1031 disqualified because you couldn't identify a third potential. It gives you like a safety net for your 1031, because the worst is when people are doing 1031s and then I'm like, oh, you missed your timeline, I'm so sorry, it does not qualify as a 1031, and you still have to pay all that tax when you weren't expecting it. So 45 days, you have 45 days to identify, and then you also have 180 days in total for to complete the transactions. And so that can, that's basically 45 days and then 135 more days to actually finish the transactions. And so if you understand your timeline and understand what's going on in your 1031, you can be really, really set up for absolute success, and you can defer all of this gain. And you can see, again, this is a combination of things, right? You do the cost seg, we completely depreciated it, we did the 1031. That's what tax strategies are all about, is you layering things onto each other and kind of combining what fits for you while you're living your life. Not you live your life based on your tax return. No, your tax return fits for you on how you live your life. So if you're in one state and you want to move to another state, let's go ahead, do that. And you can still have your taxes be not have any like big fat issues. Okay. I did a lot of speaking right there, just giving some examples for you guys to really see what is available to you. Please let me know if you guys have any questions. I want to open it up to questions right now. And you guys, I can happily answer anything.
Good job. That was a lot of information. Fabulous.
Thanks.
Any follow-up questions? Is this like going once, going twice? Well, certainly if you have follow-up questions after the fact, you can reach out directly to Nicole. Do you want to give out your contact information again, or was it on the last page of your PowerPoint?
Oh yeah, it's Nicole .Green at Robert Hall Taxes. I could put it in the chat for you guys. There we go. Um, Somebody does have a question saying, any magic bullet for someone with a home that is appreciated over the $500,000 exclusion? And so this person is talking about a primary residence, and the primary residence they're trying to sell. And so they're going to have over $500,000 of gain because if you're married, each person gets $250,000 of an exclusion as long as you have lived in that property for 2 of the last 5 years. They don't need to be consecutive and they don't need to be the most recent 2 years, but 2 of the last 5 years, you can get this $500,000 exclusion, meaning $500,000 of gain will be tax free. I always recommend that people look at how much they put into improvements because that is also part of their basis. People really, really are like, oh, I don't count all of the things because you don't get to take them as a deduction during the year because it's a primary residence. And so if you look at, if you've been in the property for quite a while, I'm quite certain there's quite a bit that you've done to the property, whether you got a new water heater, air conditioner, you redid the bathroom, new gutters, new roof, whatever. All of those go into your basis. Don't forget all your closing costs that you need to account for. If you also paid any closing costs when you were the buyer, also that goes into it as well. Or anything that you've done, any capital expenditures that you've done to maintain the property, that includes landscaping, not gardening, but landscaping, to maintain the property. That also really, really helps with increasing the basis to lower that. Other than that, no, unless you really wanted to like rent it out or put some of that money into a rental, then we could talk about doing like a partial 1031 and like, there's some benefits there for you. But I would definitely look to see how much more beyond the $500,000 that you're talking about. If we're talking like, you're looking at 2 million of gain, then let's talk about running some of that into another rental and then taking some of it. Or if you're talking, $600,000 of gain, okay, eat the 100 grand. Like, what are we doing? But that's a long way for me to say all of that.
It's a
But
good problem to
yeah.
have.
but
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 you could certainly do that, move out, convert it to rental property, rent it for a period of time, and then as long as you still qualify for the exclusion and you qualify for a 1031, that can kind of solve the problem.
Yeah, exactly. Which, I mean, again, there's so many creative ways to use 1031. People do not utilize them enough. Like they really, really don't. There's a couple of other questions here. I want to move into a property after doing a 1031. Heard 2 IRS rental cycles needed. Any other warnings about doing so? I mean, Bill, you can really get deep into this, but like there's no time frame. There's no actual real set time frame. You just need to make sure that you understand that you need to show intention. And so you need to show legitimately like that this was supposed to be a rental and that's why I did it. I'm not just trying to swindle the government. I mean, unless you want to go more into it.
Sure. We get a lot of those questions, and a lot of people out there tell people you have to hold it for a year and a day, 18 months, 24 months. Well, what is it? And so you hit the nail on the head. There is no holding period. There's no statutory requirement. You just have to prove intent. So we had a client who sold at an exchange, didn't read the CC&Rs, and found out the day after that he had to be an owner occupied. So quickly sold at another exchange. He held it for about a month and a half, and everyone told him your exchange will fail. And it was actually the Franchise Tax Board here in California, and they allowed his exchange to qualify because he could prove intent. He just didn't read the CC&Rs, so he had to sell again and do another exchange.
Yeah. It's that's
Although I wouldn't push my luck with
there's
the Franchise Tax Board very often.
they're the worst, actually.
So
The
true.
most vicious. Whatever. I'm on a recorded line here. I need to be nice. But Somebody also has another question saying that they heard they can move their tax basis as a senior in California. How many times? And then can you do this for 1031? And does it have to be your primary residence? And so they're combining a couple of really big ideas here. And so, yes, in California, for property tax, you can move your tax basis. That is absolutely true. It needs to be your primary residence, and you can do it as many times as you want, in as long as you are moving to another place in California, from California to California. Like, you can't go outside of California, and you're just going to drag your property tax rate with you up to $1 million. And so anything beyond that $1 million, it'll get reassessed at whatever the new property tax rate is. You file all of that with the county, and like when you're purchasing your home, you have to state all that kind of stuff right then and there. Can you do this for 1031? 1031s are only going to be for business use or investment use. You're not doing it with a primary residence. The transferring of your property tax rate is only going to be for your primary residence. So no, no, you're not going to be able to combine these types of things. And I just want to make a really quick note is I see a lot of, not a lot, because I talk about how bad this is, but we see several people trying to put like family members on their property, like put kids on the property so that they can have ownership and be able to transfer property tax rate and all of this stuff and avoid gain. That's not what we want to do, because step up in basis is a true and beautiful thing. Remember, we say delay, 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 die. And the reason we say delay, delay, die is because when you die, one, you don't take your tax debt with you, the stuff that you delayed, that you've said, let me put a pin in it and I'll talk about it later. Well, you died, so the pin's going to stay there forever. And the person that is inheriting this property gets step up in basis. What does that mean? You bought the property at $100,000. When you die, the property is now worth $1 million. Their basis, when they inherit it, is now $1 million. So if they sell it at the $1 million because it's worth $1 million, they pay $0 of gain. And so I know several people try to like kind of think about it on the short term end of like, oh, well, I want to keep property tax rate. Step up in basis 9 times out of 10 is going to outweigh the benefit of keeping a lower property tax rate. And so you really need to think about things long term, not short term when we're talking about tax.
Mhm.
That was my little tangent. Thank you for coming to my TED Talk.
All good though. All good. Any
Yeah.
other questions?
Hmm.
We can probably wrap it up then. Thank you so much for all that. That was some great information for everyone. And we would love to have you back as well. That would be a fantastic kind of revisit.
Absolutely.
That'd be super.
Absolutely.
So thank you everyone for joining us today. And if you have any questions, feel free to reach out to either one of us. We'll get the other one involved, or whoever's appropriate to answer the question for you. So thank you so much. And Nicole, you want to give out your email one more time?
Nicole.green at roberthalltaxes.com.
Perfect. Thank you. Thank you. Talk to you guys soon. Take care. Bye bye.
Bye bye.